Welcome to Cycles TV. This session of the Market Cycles Report is intended exclusively to provide information and education to help individuals better understand cycles and the markets. However, this information is not to be construed as professional advice as to the buying and selling of securities. In no event does the host express any opinion with respect to, or make recommendations regarding, the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading. Buying or selling decisions are solely within the personal discretion of each individual. And now, enjoy the show. Here is your host.
Welcome to the Foundation for the Study of Cycles. My name is Lars von Thienen. You're watching Cycles TV. And yes, I am back from a short holiday trip. To be honest, next week I will still have a short trip, but I wanted to make and to use the opportunity today to get back in touch with you on cycle analysis. Yes, cycle analysis. So, what's up for today? I have prepared some interesting topics to talk about. First, as always, we need to start with an update on the S&P, so the global stock markets with the US Standard & Poor's 500 first. Then I want to give you an update on gold because we did an analysis back in May. And I want to revisit this analysis and we are now on another important and interesting maybe point in time regarding gold. Last but not least, as always, if I am on holiday, I use the time to dig into some science-related topics. And there's something really cool showing up here for our cycle analysis. That's for the colleagues and our members which are interested in a little bit adding more scientific tools to our cycle analysis tool set. That's it for today. Running 20 minutes, 30 minutes. We are live, so for sure, drop in your questions. I will take, as always, the time at the end to try to get back to your questions. So let's directly jump into this session with the S&P 500 first. Therefore, let's grab the latest and greatest data. This is the S&P 500 here with the latest data. So this upswing and all the periods starting from March to more or less July, August was a tough timing period for cycle analysis. Cycles failed during May, early summer to give us some reliable signals. Maybe the situation changed now, and I think I told it to you before I went into holiday. So let's revisit what the cycles tell us here. If we first have a close look at the spectrum at the bottom, we can see that it's not as easy to pick the right cycle here. So we have a lot of smaller cycles here with a similar length, or at least amplitude lengths, and a lot of shorter term cycles here to the left. So that's not the easiest. And then huge upswing here, which looks like we have a long-term cycle on the daily, which would make more sense to move to the weekly. So let's focus on this area here. So there would be three possible cycles, just looking at the spectrum. Here we have the cycle length of 80 days, 106 days, and 180 days, which is this one here, which is shown right now. So now we need the guidance of additional features or possible measurements which to pick, because the spectrum alone and these peaks in the spectrum just alone would not help us here. We could do a composite if we don't know what to pick, but as you see, we need guidance from our artificial intelligence, which will help us picking the right cycles. So therefore, let's look into the table here on the right, and you see that we have a ranking, and the ranking includes our different measurements which cycles should be picked for projection. And the first highest ranked cycle here is with a length of 80. And then we have several shorter term cycles with but very low scores. So even there are more. And the second ranked one is here the 180. So moving back to the spectrum, using the guidance from our artificial intelligence, we should use the one with a length of 80. And then I think, no, it's not this one here. It's then this one here with a length of, what is that? It is the 180 days cycle. Okay, so let's start with the highest ranked cycle first. So this is a cycle of 80 trading days. And if we have a look here at the upper swings, I think it matches nicely just the cycles if we go back here into 2021. The only period which is then out of sync, and this is the period which I told you was at least a very tough one using cycle analysis here from March to June, where more or less all cycles have not been of any help. But if we have resynchronized to this cycle here, so this could give us an indication, because in the past, this cycle worked really well. So if you just have a look at the past turns, it was just out of sync during the early summer period here. So it is a valid cycle and is still the most dominant cycle picked here. If we resynced back, so even this upswing here is aligned with this cycle. So now, and it turned right at this point. So we could now see the downswing into September. And this is what I always told you from a long-term perspective. We should be on alert for a final downswing late this summer. And this could now be this downswing into late this summer we are seeing here. Just picking the 80-day cycle. Let's now add up the second recommended cycle here, 180 trading days. And you see, and this is what I'm often doing here. So now just monitor the screen. I'm flipping forth and back between these two cycles. And what I'm looking for, if the most interested projection area, so this is the projection where I'm looking for, where we expect the next change in trend to occur here in September with this downswing. If this projection is changing, if I now deactivate or activate this cycle forth and back, and you see that the projected bottom here is not really depending on using one or both cycles here, right? So that's even a good confirmation here that even just using one, or doing both cycles, it seems like at least the longer one is even moving into starting of the winter time here. So this period here seems to be a period where another low could be expected. Maybe the September, October is always critical period. So that's the cycle perspective. We can now add the cycle RSI tuned indicator. And this is now interesting because from that perspective, here during the period where the cycles have not been really of any guidance here, we now see that starting August, we have the first signal crossing below the upper band, which is indicating or confirming also from the technical perspective a possible top here, and we have now room to go or room to move below the lower band. This has not happened since June. We always hovered above the upper band, and now for the first time we touched down. So this cycle top here, from a cyclic timing perspective, has been confirmed by the cyclic RSI indicator here. So this is what we're looking for. We have not seen these kind of signals for a long time, as said, between April, May, June, July. So it's now nice to see cycles, technical indicators, and price has turned now into sync, which from that cycle analysis perspective would indicate now that another downswing into late summer has started, which we have been waiting for. I mean, we have not anticipated this strong up move with cycles. But let's see now if we can now come to the expected leg into late summer, which could be a downward movement in the US stock market. So that's it for the first analysis. I think that's important to follow up. The second topic for today is talking about gold. Yeah, so let's also have a look on gold cycles. And for that purpose, I just want to recommend, if you're interested in a longer term analysis, you can check out in May this year, if you browse the Cycles TV Monday library, you will find beginning of May, I did the analysis on gold. And let's quickly just bring it in here. So you will find it in our Cycles library. And this was the analysis at that point in time. You see it here, Market Cycles Report, May the 8th of this year. Let's zoom in. This is where we have been in May. Yeah, gold looked like, or the question was, will this upswing continue? And I showed you this cycle here, the cycle analysis based on 2 dominant cycles. And I told you we should expect a down move, yeah, from gold into August, which is more or less exactly today. Yeah, so that's why I'm just pulling up this analysis back from May, because now we arrived at the expected down move, and now we need to check first, did gold really follow this cycle projection? So did we observe the down move into today's period? And then let's update the analysis on gold, what we can maybe see in addition. So for the long-term analysis, move back to that video. It's there, which shows the projected down move into August. And now let's open gold here with a new fresh chart. So you see here, this is where we have been in May. Yeah, so that's has been the point of the analysis where we did the projection of a possible down move into August. So which looks quite nice, since we have moved from touching the 2000 now. I think we moved down 5%. So our downward projection worked quite nice. Yeah, so we picked the top right on time. With the projection, we could now see a downward swing into August. So now we have August. Let's update the cycle analysis. That's what I want to do with you here today. In that case, we see clearly 2 very prominent cycles in the spectrum here. I think there we don't need any guidance from any computer-aided guided intelligence here. So these 2 cycles are of interest. Yeah? So the first one with a length of 209 days, and the second one with a length of 320 days. First, and that's always what I recommend, let's see how they cycles match to the cycles we have used and detected back in May. So therefore, let's just get back to that session here, which we did. And you can see, I don't know if you can, or if it's really readable here from that screen. So it was a cycle length of 330 and 216. Yeah, if you see it here on the screen. So 216 and 330. These have been the 2 dominant cycles back in May. And if I now switch back to our current analysis, you see here the cycles with lengths of 209 and 320. So they are very close. So more or less these are exactly the same cycles, 209, 320. And you can see here the principle of variation. So the length is not exactly the same. Cycles do not stay static. Therefore, it's always important to redo our analysis. I would conclude We still have the same nominal cycles in our analysis, but now the cycle scanner allows us to resync what is the current length of these 210 nominal cycle and the 330 nominal cycle. So the length switched to 209, 325, and also the phase has changed. So yes, we have the same cycles, but now we have the benefit using the cycle analyzer coming up with the exact length. What's the length now? And what's the phase now? So now let's apply both cycles and bring them up onto the chart. So here's the 209. Let's just zoom in, and it follows the projection quite nicely what we did here back in May. So in May we showed you it's topping here, and we would expect mid-August the cycle to bottom. That's exactly where we are today, and gold moved down to that period. So I think this cycle is still stable, showing now the next upward cycle. Let's now add the 320 something, which is flattening out if you add both up. So we have arrived, even adding both into the mix here, we have arrived here now closely to the expected low, maybe a little bit extended into end of August, beginning of September. But I would now more add the technical analysis with the cyclic RSI, bringing that into the mix. So just activating it on our platform. And here we have an interesting perspective, because two things happened here. Hope you can see it here. First, in the May analysis, where we highlighted the top or the possible top of this cycle here, this was in alignment with the cyclic RSI crossing down end April and beginning of May, so even a short divergence here. So this was confirming the top in May here. So now, if we now from a cyclic timing point of view arriving at the bottoming cycle, we see that we are close to pulling below the lower band, which might be in confirmation. So we could see some extended downward follow-up, maybe into late August. And then you see that the lower band is also uprising. This could then be an interesting point for gold, maybe to have an upward correction, but we need to monitor how this technical condition here could confirm a low or not. So, but we are close now to arriving to that point in time, and therefore I was thinking about it's now important to pull up this analysis from May, have a revisit on it, so have a key or have a view on gold if you are interested in that asset class. And last but not least, just for the members out there who are interested in some more scientific stuff, we are really working hard behind the scenes to improve the cycle analysis application. And as you know, that dealing with cycles, it's also important to get the best view on what's the trend in the underlying asset we are analyzing. Because if you have the trend or a different method to detect the trend, and then also have another method which can detect cycles, and you can then bring both analysis into alignment, or at least cross-check if they match, if they agree or if they disagree, then I think trend analysis and cycle analysis on one hand and the other hand will really stack up in regards to making a decision for that possible asset class. And if it comes to trend analysis, there has been a lot of improvement in the science community around detecting multiple trends, because there's always not just one single trend, upwards, downwards. There are multiple different trends in the data set. So we have shorter uptrends, then maybe stronger uptrends, then the downtrends and sideways moves. So a series does not only consist of one single trend. So detrending a series under the assumption that just one underlying trend is anyhow wrong. So we need to find methods being able to detect multiple trends in the data set, very reliable. And there, I think 2 or 3 years back, there has been a very interesting scientific article, and I want to share it with you. And it's also in the application, which will show up during the next days. The article has been published in Earth and Space Science. So this is a scientific journal. And it's titled The Robustness Assessment of the RSDT Test for Detecting Trend Turning in Time Series. And that's exactly what we are looking for. So I will post the link also below this video here. So this is a public scientific article. What makes this interesting? So important for us is that this has been used in climate data. So, and in climate data, we have the same situation, that you want to detect trends in different time frames here. And it's about multiple turning points which are in the underlying data set. And as said here, the RSDT test is the recently developed method for detecting trend turning points, in that case in time and in climate time series. And if you follow the article, the conclusion of that article is that the RSDT test has a very strong capability or capacity to detect multiple turning points in data series, and a great performance of reducing false alarm rate. So I will not dig into the research here, but there's now really scientific evidence using the RSDT test. So that's not an easy one, but we have coded it already in our cycle analysis application. We have a beta test up and running with the RSDT test. So this is not just pure science. We brought it into our cycle analysis application. We are running some first test for you. So we need to be sure that this is really, really working and useful in our cycles environment. But it looks quite impressive, because then we have another unique feature. Besides cycle analysis, then we have the technical analysis with the cyclic relative strength tuned indicator. And third, now we will bring in the latest and greatest of trend analysis. And then we can also see if cycle projection fall in alignment with trend detection. And there are different topics and follow-up procedures which could be used once we have the trend detected. So therefore, yes, even if I've been 2 weeks on vacation, vacation gives me the freedom to work on things like that. And as I said, it's already coded in a beta test. So maybe during the next week, I can follow up here if you're interested with some first examples. And in the advanced community, I will share then the first usage for some beta testing in our members community. So that's it. A really compressed 30 minutes, 25 minutes, analyzing S&P gold and giving you some forward projection, what's showing up in our cycles community. So if you want to discuss with me now some topics, feel free to continue in the chat. So I will now have a close look what's up in the live chat. Okay, let's start with some questions. B. Schmidt, being a premium user, we get the charting tool as it looks to be TradingView software. If we have an account that gets live quotes, is it possible to get live quotes into analyze the chart from TradingView? Yes, and if you are a premium user, it is possible. First, it's correct. We have access to the TradingView charting library. So you are referring to this kind of charting analysis we have integrated for our professional premium members into the software. So you can use the familiar environment, which you might be familiar with from TradingView. That's their library. They share their library with some professional institutions. So we use the TradingView library to plot our cycle analysis data. That's correct. And if you have an account on TradingView, which allows you to use live quotes on TradingView, you can integrate it via our streaming interface. It's a little bit complicated to set it up once, but you just need to set it up once because you need to set up the alerts on TradingView, which then allows to pull the live quotes into the cycle analyzer, and then it runs in parallel. So you have the exact same live quotes, which you see in your TradingView application, in the cycles analyzer, even for intraday analysis, updating live. It is possible. I don't want to use this session to explain it. I would recommend, please send an email to our support and service colleagues. So Liz or Wes from our support team can guide you through the process to set this up. So start that way. You can refer to the session where I recommended to send out to the service colleagues, and then they hopefully, at least if you're a premium user, they will help you set this up. So, Juicebox Boy, you're using a 3-year sample. Does a smaller sample size with shorter cycles work? Yes, for sure. The reason I'm using a 3-year frame to analyze the data has a for sure reason to do. So 3 years, I think, consist of around 800 to 800 data points using trading days. Yeah, around 800. And that's what I always recommend to use at a minimum if we're dealing with trading days. So the longest cycle we want to detect is around 300 to 400 trading days. And I always say you should have a minimum of a multiply by 3. So multiply 300 trading days multiplied by 3, you get up to 900. So which means you should have around 900 data points for your analysis, which would give you the chance, or the analyzer the chance, to detect 3 full repetitions of a 300 days cycle. So that equals roughly the 3 years sample I'm using, detecting the current cycle length in the current phase. That's what I always try to explain. You can use more historical data, but then you are more or less just averaging over the historical past. What is the average cycle length? If we are doing projections into the future, we need, or we should not use more than what is really useful, because we want to know the current cycle length and phase. So, but in regards to shorter cycles, maybe you don't need that much data. So 2 years might be enough if you're just interested in shorter day cycles like 30 days, 50 days, or 100 days. Maybe just 1 year might be enough then for 3 repetitions. Or if you want to even go into shorter cycles, I then would recommend use intraday data. Like you could use 200 2-hour bars, or even 1 hour bars in your analysis, which would then give you the chance to detect intraday cycles on a 2-hour or 4-hour chart. That works very well. You just need to bring this data by yourself, manually upload this data, because we don't provide intraday data, or set up this streaming integration if you are a premium professional user. Alan, I see your point here. Today you said the 80-day cycle on the SPX. The scanner says the correlation is only 35%. Can you explain, please? Yes, it's a very valid question. So let's get back to that analysis. Give me a second to get back to that chart. Give me a second. So we use the S&P daily. Okay, here we are back. And we use the 80 days, which was also picked. I just need to activate it again. Scanner. So the 80 days cycle, which has been selected here, number 1, I pick that cycle. We discussed this cycle here, but you are referring now to the correlation score of 35%. That's what your question is about. So we have just a very low correlation, just looking at that number here. And why did I pick this cycle? So even though it seems like have a very low correlation, from a correlation perspective, you should have a value above 50% or even higher, up to 1 to have a correlation. So this looks like the cycle has a very bad correlation between price and cycle here for that analysis. So let's discuss a little bit on that correlation topic, because it's an important topic. I will try to give you some thoughts on that. And just upfront and first, I really don't like the correlation score, because correlation, what is correlation doing? It's measuring the price movement, this is the price movement here, against the 80-day cycle here. But the reason why this correlation is low or might be low, and the reason why in most cases I ignore the correlation score, it was just brought in because it was requested. The cycles information is just used, and I'm always stressing this, for timing purposes. So we are looking for possible tops at these points here, which I'm labeling here, and for possible bottoms. Maybe I need to hide your question for a second. Okay. At these points here. So, but the correlation is also measuring or comparing if the price movement correlates to the cyclic price movement. And you see here we have a very high distance between this top and that top. So if you just compare, the price has a very low correlation, because the cycle is suggesting much more upswing here from the price information than the real price did. So just taking into account the upward movement that has not matched. But from a timing information, it was more or less perfect. So what the correlation also takes into account, if we have traveled the same distance in regards to price. So here we see we have missed it from an absolute price projection. This cycle top, which projected a huge absolute price up movement, was not reached. So the correlation, which takes into account both dimensions, what was the price traveled and what was the cycle amplitude traveled, and we have a huge distance. So this gives us a very, very bad correlation, because we always missed the distance of the price movements here. However, if you just look at the timing information, which is just one part of the correlation, it's good. But the correlation takes both into account, and that's why I always said, or at least I completely ignore that kind of correlation, because it's always a correlation between price amplitude movement, which should never be used for this cyclic projection purpose. Therefore, yes, we have the correlation as information, but even a bad correlation score, and I hope I gave you at least the guidance why a bad correlation score does not mean the cycle is bad. It just means, or in this case, it means that the price projections have been off. Yes, we know we are not looking for price projections here. However, the timing information was good. So that's why maybe we will bring up some different measurements here instead of the correlation score. But I hope it helps to explain your question, Ellen. Yeah. Moritz, I'm not yet a user. Could you elaborate on the difference between standard and pro version? Yeah, let me try to at least quickly let's clean up this screen here. We don't need that. The standard version comes with basic cycle analysis and mostly what we're doing here in this weekly session. So the pro version then adds up some additional features like, for example, the TradingView charting integration. So additional charting possibilities are only available with the pro version. If you want to analyze intraday data, you need the pro version. If you want to have the cyclic tuned RSI technical indicator, you need to have the pro version. So the standard version gives you the basic cycle analysis on daily charts. If you want to have the additional features like intraday, like charting, additional indicators, intraday cycle analysis, then that's the pro version. So at least in short terms, it should give you some guidance what you're looking for and what you get. But you can upgrade, downgrade always as you go. Maybe I think it's 2 comments. No, it's one comment, right? Yeah. Hurst, he is determining the length on the throw to throw. He puts a lot of emphasis on the throw all over his work. That's correct. That's how Hurst did it in the past. And I agree. If you just look at the price series, the throws will synchronize in most cases, which will give you the opportunity, if you visually spotting cycles on a price chart, they will become more visual on the price chart on the throw. But only if you don't use digital signal processing. So therefore, in the area where we didn't had digital signal processing at our fingertips, I think it was a very valid approach because he wanted to visually align or synchronize the cycles at the throws, which is fine and which is absolutely right because visually they become more seen on the price chart. Tops from different cycles might then align on not exactly on the same day or minute or month or whatever you're looking for. So they are not easily to spot on a price chart because composite cycles, they stack up on each other. Maybe on the price chart you will see a longer sideways move, so you don't see the possible top on the price chart. So that's why if you just need to visually spot cycles on the price chart, use the throws. If you have access to advanced digital signal processing, we are not related to that approach, seeing cycles. And I think that's the next step now. Hurst he depended on analyzing the raw price series by visual inspection also, then connecting the throws and the peaks and just synchronizing them on the price chart. Now with digital signal processing, we can detect both with the same accuracy. So I think that's just the basic information why we don't rely on that approach he used in the past. However, it's still valid. So that's sad. So it's not invalidated. It's just that we don't rely on visually spotting cycles on the price chart. So that's why we can use a little bit different approaches here, Lean. So I hope this helps a little bit on that. I see, and I would assume from a timing perspective, thanks for showing up again here and raising your questions. I hope you got some feedback from me here and maybe some directions to think about. So I'm back next week Monday. So even though I'm traveling this week, let's visit here, and I hope to see you again next week Monday, same time, same place. I hope you like the S&P and the gold analysis. And if you want to dig in the RSDT test, feel free. It will show up in the application during the next weeks. Have a safe week. See you, and